just thrilled to be joined by Philip Straehl. He is of Morningstar Investments, the Chief Investment Officer for the Americas. He joins us for the second time. Philip was with us a number of years ago, making a comeback. Glad to have him here. Philip, thanks for a few minutes for Tranquilli Financial Advisor clients and everyone that watches and listens to our discussions.
Thanks, Lou. It's great to be with you, and thanks for having me.
Of course, yeah. So we'll jump right into it because we say this is on repeat. We could just add it to the beginning of every video that we record. What a time for investments. All right. So if I can, I'd like to start with the most obvious discussion to have: investing during a time of war. The U.S. being a driver of so many economies, not only our own, of course, but the extension of our dollar across the world. Give us the 101, if you will, on investing, how Morningstar looks at it during a time of war.
Yeah, look, I think from our standpoint, we're long-term focused, and when we build portfolios, we want to make sure that we can, hopefully withstand and provide, diversification and ultimately good investment outcomes in different market environments. And obviously, wars are things that have happened, are continue to happen. And we look to construct them in a way to make sure that we have a degree of robustness. And so obviously, there's always a human cost, to war. And if you're an investor, you kind of have to, sort of put that to the side and say, okay, what does that mean in terms of dollar and cents? And if we look at the impact of wars historically, markets have certainly sold off initially. But if you look at prior, wars, really the impact was more temporary. So, that gives us some confidence that oftentimes, there's a relatively quick bounce back. Oftentimes, the assets we invest in, so many people, of course, have significant exposure to U.S. corporations. They don't have direct economic exposure to the war, to the impact of the war. It's more indirect, and there's kind of a unique element as well to the war that's happening now, with the key focus on energy and just the importance of the Strait of Hormuz in this conflict.
All right. Well, thank you for that. And certainly the human element of it, Philip, you and I, much respect for that and appreciation for those people who must be on the ground. And I can't help it, but thoughts and prayers are always with them, as I know yours are as well. With that, we talked a little bit about diversification of assets and what that means now. Go back, and you don't have to go back. I'll go back, say 18 months, 2 years. And it was technology. Everything was technology. We've talked about the concentration of technology stocks within the S&P 500. We've talked about how much I dislike using that as a comparison for people's portfolios, because it is so overly concentrated in technology. I think right now the theme that I'm gathering from Morningstar in general is that be more diversified than that. Whereas concentration for that period of time looked good on the bottom line. Being more diversified, even bringing in more of the conversation about bonds and what type of bonds. Talk to us a little bit more about what the strategy is right now at Morningstar on bonds, on diversification, please.
Absolutely, Lou. And, just going back, you mentioned technology, kind of the streak we've had. And I would just remind listeners that, we've at the end of 2025, we've went through a period where equity markets in the U.S. were up by 85% cumulatively. And so that was just an extraordinary period. And that has kind of pushed valuations to a certain level. And, oftentimes markets, when you go through a period like that, you sort of think that's just going to continue indefinitely.
The way it always is, yes,
perhaps. Right. And so markets have short-term memories. We all do to some extent, and so we'd like to remind investors, and with our process, to make sure that we can be ready if something. The regime changes, and many would agree that in the first quarter of this year, we have seen a regime change. And specifically, we have seen Early on, there's several things that happened that really impacted markets in the first quarter. One of them, there was a conflict that started at the beginning of the year with Venezuela that also impacted energy prices. And of course, more recently, we've seen the conflict, the broader conflict in Iran. And I think that's, if you take a step back, it's really a stagflationary shock to the system, because you have, increasing energy prices, because 20% of global oil goes through the Strait of Hormuz, and so we've seen significant increases in energy prices, and that sort of then translates through the system through higher interest rates, through higher inflation expectations, and so that has a meaningful impact on the capital markets. And so, from a diversification standpoint, what it meant is that bonds, nominal bonds, treasuries were actually not effective in helping you in March. And so you had to look at other sources of diversification. And so what we do with our investment process is we try to stress test our portfolios against different combinations of specifically growth and inflation, and making sure that we stress test our portfolios against a scenario where you might have lower growth and higher inflation, which is exactly the shock that we've seen in March. And so having some allocations to TIPS, Treasury inflation protected bonds, having allocations to, let's say, non-directional alternative strategies. We have a Morningstar Alternatives Fund, which held up better in that environment. And so that's sort of how we would think about what we went through in Q1 and kind of the paradigm shift in some ways that we've lived through vis-a-vis kind of the technology rally that really led us to this point.
Right. And then it all seems so easy, but that's when it all seems so easy, that's usually when it's most difficult. It sounds like a line, but it's not at all a line. It just seems to be, this is the way it'll always be. It is not. So with that, a couple of things in there, Philip, please. You said treasuries did not help. If you would define that, what does that mean that they did not help?
Right. So there's certain environments where treasuries provide ballast. And, obviously, bonds offer much better return than they did, 5 years ago, say, right? You're still getting, 4 or 5% return. And so it still makes sense as an investment. But when we think about diversification and, kind of building robust portfolios, we look at how does an asset respond to an economic event. Treasuries, nominal treasuries, tend to do quite well in periods of a recession, for example, that is not inflationary. So you have, a credit crisis or, some sort of regular downturn. That's when interest rates tend to go down. The Fed has the ability to cut rates into a cycle like that. But of course, given the source of the shock this time, you actually had interest rates increase. And so if you look at rate expectations in January of this year, the beginning of this year, relative to where we are today, the expectation effectively is that the Fed funds rate at the end of this year, at the end of 2026, is roughly 60 to 70 basis points, so 0.6 or 0.7% higher than what we expected going into this year, because the Fed now has less flexibility to cut rates because they're now seeing higher inflation. And we have also seen a higher inflation print last month.
Okay, thank you for that. And so in other words, the bottom line from my vantage point, took away one of the Fed's tools to be effective in help pushing along the economy if necessary. It really, because of the inflationary environment, they really can't act as they might want to.
Exactly.
All right, so it leads to this question: the old 60-40 portfolio, and I call it the old 60-40 portfolio because I've been doing this 35 years now, and that qualifies as old, but it's been around forever. Is it time to start drifting, maybe not to 60-40? And I'm not asking for any specific advice for clients. I'm just saying, looking at the amount of bonds that could be held in a portfolio, a reasonable amount of bonds to be held inside a portfolio, should we be looking closer to that traditional, I'll call it, not the old, the traditional 60-40 portfolio, maybe not quite 40? Thoughts on adding that level of bond holding to portfolios?
Yeah, I think so. First of all, I think relative to, as I mentioned a minute ago, I think bonds actually offer better absolute value than they did in most of the post global financial crisis period. So I think after we've seen the reset after 2022. So you just get a lot more ballast, from your fixed income portion. You just have, even in an actual more traditional downturn, the Fed does have room to cut, and so I think there's a case there in our estimation, our opinion, to own fixed income. And so I'm not, suggesting that we should, kind of fundamentally rethink portfolio construction on the basis of what we've seen, and some people, have the tendency to kind of just over extrapolate it as well around, this particular.
We'll get to that. Yes,
but I will say, when we are thinking about robustness and how to build portfolios, we are now in an environment where inflation seems to be higher than what it was in a post global financial crisis environment as well. And so we're looking at additional sources of diversification beyond nominal bonds, whether it's tips, whether it's alts, whether it's also owning, some foreign bonds that are hedged back into the dollar, just because you have a bit of diversification as well with respect to other yield curves. And so there's ways that you can just at the margin add additional diversifiers into the mix and not be solely reliant on sort of the 10-year treasury, if you will. And that's sort of how we're thinking about it.
All right, excellent. That's excellent context and appreciated. So not necessarily a percentage, but the diversification, back to back to where we started of the portfolio, which we are all about. We love the idea of diversification, not only working with Morningstar, but as you're aware, we work with a number of different money managers. We're diversifying theory throughout portfolios as much as we possibly can. So leads to the short-term predictions. And again, and just having a quick conversation before we started recording, you brought up what I thought is an excellent point about watching, listening, reading about different short-term predictions and taking that information, applying it to portfolios, or maybe what we think we should be doing, but is that what we should be doing in your professional opinion?
Yes, I think it's really hard, to accurately forecast short-term events. And I think, what happened in the first quarter is just a great example of that, because if you look at what most people's outlook was going into 2026, what dominated headlines at the beginning of the year relative to what's dominating headlines now is just very different. Everybody was talking about a rate cutting cycle and how there's going to be 2 or 3 cuts, and that's going to kind of feed through the system. People talked about how inflation pressures were easing because of tariffs having kind of moved through
normalized
the system. Normalized. And so, yes, and now we're here 3 months later, and the playbook has changed. The Fed is likely not able to cut meaningfully, if at all, this year, and inflation is very much back on the table. And so we think refocusing on a quarter ahead, 12 months ahead, to 3 years, 5 years ahead. We think that just makes more sense in terms of an investment approach when you're thinking about multi-asset portfolios, when you think about investing in individual stocks, because we think there's just more predictability there in terms of future outcomes. That's how we're kind of grounding our investment process.
Excellent. And Philip, we'll almost leave it. Leave it there, because there is one more topic that I think is an excellent topic, and I've been reading about it. I've had a few clients send me the topic of auto manufacturers. I think this is well worth discussing, because when to name names, because they named themselves, Toyota, Honda, and Ford say, if we deal with Chinese auto manufacturers on a day-to-day basis, we're going out of business. Now, that is a panic, short-term prediction from the auto manufacturers themselves. I don't believe they're going out of business, but it is a very important asset class, we'll call it, the auto industry, the manufacturing industry in general. What is that impact? What impact have you seen, if you will? And apologies for my phone going off, but what impact are you seeing from in within the auto manufacturing? You don't have to give us a long time on this one. It's very specific, and I usually don't get quite that specific, but I think it's an interesting case because an industry that is core to the industrialization of mankind. So now we're here talking about Ford, call it the developer of the production line, saying we could be put out of business. I think that's worth a minute or two of this discussion.
Right. Yeah. Look, auto manufacturers, they've had a difficult time, for a number of reasons. They were impacted significantly by the tariffs, of course, because they're sourcing a lot of the auto parts from different parts, around the globe. And then you had investments in EVs, probably somewhat of an overinvestment that happened there, and so that had an impact on many manufacturers. So I think they're a bit of a difficult spot right now, which I think is why you're seeing some of the headlines. I think it's important not to overreact, and I think from our standpoint, as we think about businesses, we think they can be an industry that can be challenged, but even within that context, they can be strong franchises that despite some of these headwinds, they can still have an ability to do quite well in this environment. And so we think companies like Ford, or if we look at outside of the U.S. as well, companies with strong franchises like BMW, Ferrari, they just have kind of niche opportunities within what is otherwise a more difficult economic environment. So I think auto it's meaningful. I think these companies will find a way to right size kind of their lineup and react to some of these pressures. But they have had a couple of shocks that impacted them meaningfully in recent years.
Where would Tesla fit in that? Is it a niche? Is it and I'm not asking for a prediction on the stock or anything, but the company itself, is it a technology? How do you see Tesla within the auto industry? Is it in the auto industry? Is it in the technology? Is your outlook on that or your viewpoint of that, please?
Yeah, I mean, Tesla for Morningstar is a difficult stock because we don't think it really is valued in trades as an auto stock. If you look at the valuations, and so you have to believe in a future of Tesla that goes far beyond auto manufacturing and really has to go into like the humanoid type robots and other applications. So Tesla is not a stock that our analysts or our PMs have significant conviction in, but it's very much unique stock. Obviously it's large, and so you need to pay attention to it, but we do have a hard time really comparing it to traditional auto manufacturers just because of the optionality of what Elon Musk might do in the future.
Sure, and thank you for that answer, because that's just what I was getting at. It is tough to pin that one down, so to speak. So, Philip Straehl, the Chief Investment Officer for the Americas Morningstar, thank you for just about 25 minutes here. Went a little bit longer than expected, but I had to keep you because the opportunity to talk with you again. The question I will throw at you right now is this: will you do it again with us?
Absolutely, Lou. It was
excellent. Okay, good. Thank you so much.